Welcome to another TCP walkthrough video. I'm Logan, and in today's video, we're going to be going over annuities. And we're going to be doing that the super fast CPA way, which is diving straight into questions to learn the material. Now, if you don't know much about our strategies, make sure to go to superfastcpa.com and check out our free 1-hour webinar training. Again, it's free, it's 1 hour long, and we teach you the key ingredients to passing the CPA exam. You don't want to miss it. The link will be in the description. Also, just letting you know, we will only be going over 5 questions in this video, but Superfast CPA members will have access to the full 10-question video when we post it in the members forum. So if you like this, you can get more of it and more practice by becoming a Superfast CPA member. One last thing, this is a continuation of our short little group of videos that are talking about different retirement plans. So if you haven't watched the video about traditional IRAs or Roth IRAs and 401ks, make sure to watch those so that you can kind of compare the advantages and disadvantages of each retirement plan. With all that said, let's dive straight into the questions. Okay, here is question 1. John Smith, aged 60, invests $100,000 in a fixed annuity that promises to pay him a monthly income for the next 25 years. Based on the terms of the annuity, he expects to receive $500 each month. If the entire principal amount is considered in the exclusion ratio, calculate the portion of each monthly payment that is not subject to tax. Okay, if you don't really know what an annuity is or how it works, that's okay. We're going to learn that. If you have a general idea, go ahead and pause the video and try to do the calculation yourself. And when you're ready, come back, we'll look at the answer together. Okay, the answer is $333.33 of each monthly payment is not subject to tax. So let's go through this. The exclusion ratio involves dividing the investment in the contract by the expected return. The expected return is the monthly payment times the number of months the payments are to be received. Here's how you would calculate it. So first, you take the total expected return, which is $500 each month, multiplied by 300 months, and you figure that out by multiplying 25 years by 12 months in a year. And that gives you a total of $150,000 that's expected over the course of the annuity to be paid out. And then you calculate the exclusion ratio by taking the initial investment, which is $100,000, that's the money that they put in, divided by the total expected return of $150,000, and that gives you a 2/3 or a 66.67 exclusion ratio. We apply the exclusion ratio to the monthly payment, so that means out of the $500, $333.33 of that is not subject to tax. It's excluded from tax. So why is that? That's because it's technically a return of capital. And we're going to learn about that in future questions, so keep that in mind. The scenario described involves a fixed annuity. In a fixed annuity, the insurance company guarantees a specific amount each month, which remains consistent over the term of the contract. This contrasts with a variable annuity, where payments can fluctuate based on the performance of the underlying investments. Now, I just wanted to throw that in there so that you know that there are different kinds of annuities as far as fixed or variable. For the CPA exam, mostly you're going to be focusing on fixed annuities, so just keep that in mind. Let's go ahead and go to the next question to learn more. Okay, here is question 2. Which of the following statements best describes the difference between an employer-sponsored annuity and an individual retirement annuity? So apparently there's 2 different kinds of annuities, employer-sponsored and individual retirement. Just based off of that, by the way, you can probably think through these responses and kind of reverse engineer your way through it without even knowing very much about annuities. Just think about what the words mean. With that said, try to figure this out, and when you're ready, come back, we'll look at the answer together. Okay, B was the answer, and that's that employer-sponsored annuities are offered through a retirement plan like a 401k or a 403b, which may include employer contributions and special tax treatments, while individual retirement annuities are purchased privately through financial institutions and funded solely by the individual. Okay, so let's read through this whole explanation. Annuities are a financial product sold by insurance companies that provide a stream of payments to the holder at future dates, usually during retirement. The main purpose of an annuity is to reduce the risk of outliving one's savings, providing a steady income regardless of other investment performance. There are several types of annuities, including fixed, variable, and indexed, which differ based on how earnings are calculated and paid. Again, we're focusing mainly on fixed annuities in this, so just know that. Employer-sponsored annuities are part of a broader retirement plan like a 401k or a 403b. They are typically funded through payroll deductions and may include contributions from the employer. These annuities benefit from being part of tax-advantaged retirement plans, which can defer taxes on contributions and earnings until withdrawal. Then there's individual retirement annuities, which are purchased independently through a financial institution, not through an employer. Individuals fund these annuities with their contributions, which can be made with post-tax dollars or through a traditional IRA for pre-tax advantages. The tax-deferred growth is a significant benefit, and withdrawals are taxed as ordinary income, similar to employer-sponsored plans, but with potential employer contributions. Now, with all of that, the main idea behind this question was to teach you what an annuity is. Basically, you put money in, and then you will get a little bit more money paid out each month so that you just have a constant flow of income, most likely in your retirement. Now, employer-sponsored and individual retirement plans, you might not see that too much in the CPA exam, but I did want to make sure that you knew there is a difference between the two. One is from your employer, obviously, and one is you specifically purchasing it directly from an insurance company yourself. Let's go ahead and go to the next question. Okay, here is question 3. John Doe purchased a non-qualified deferred annuity for $100,000 in January 2010. The terms of the annuity specified that starting in January 2015, he would receive monthly distributions of $600 for 20 years. John passed away in December 2023, having received these distributions regularly. Calculate the total contribution amount that can be deducted on John's final tax return. Okay, again, this is something we don't really know how to calculate if you haven't dealt with annuities before. So if you want, go ahead, pause the video, try to figure it out. But if not, let's go ahead and look at the answer to start learning how this works. Okay, and the answer is $55,000 can be deducted from his final year tax return. So let's read through this. First, we have to calculate the total distributions received. He's been receiving monthly distributions from January of 2015 all the way until December of 2023 when he died. So that means all of 2015, 2016, 2017, 2018, the entire years, or basically 9 full years because we're including December at the end of 2023, that equals 108 months. And you can take a second and think about that if you need to, but it's 108 months. You multiply that by $600, so that's how much money he received over the course of the whole thing. Now we need to figure out how much of this amount it was actually a return of capital. So we calculate the original portion, which is taking the total expected return, which is 240 months times $600 a month, equaling $144,000. So that was the expected return over the 20 years. But the monthly return of principal is the original amount he put in divided by the 240 months, giving you $416.67 per month, being a return of capital. So the return of principal or capital is 108 months times that return of principal each month, equaling $45,000. So that's probably a little bit confusing, but basically this is the amount of this $64,800 that he's received over the past 9 years that is actually just a return of principal. It's just a return of the money he put in. So we subtract that $45,000 from the total contribution he put in, meaning that there's still $55,000 of the money that he put in that has not been distributed yet. So this can be taken as a deduction in his final year tax return in the year he passes away. So let's go ahead and go to the next question to keep building on this. Okay, here is question 4. Lorelei Zhang purchased a non-qualified deferred annuity for $120,000 in January 2015. The terms of the annuity specify that starting in January 2020, she would receive monthly distributions of $700 for 25 years. In the tax year 2024, calculate how much of the annuity income received is reportable on Lorelei's tax return. So we're assuming for all of 2024, how much of this is reportable from the annuity income as income on the tax return. We've done this a couple times in the video. You have to figure out how much is principal and how much is extra that's been earned on top because of the annuity. So make sure to remember to do that. Pause the video, do the calculation, and when you're ready, come back and we'll look at the answer together. Okay, and the answer is $3,600. So again, we have to do the same thing we've done before. First, we calculate the total expected return, which is 25 years, that's 300 months. So 300 months times $700 a month means $210,000 was the total expected amount. We take the monthly return of principal, which is $120,000 because that's how much she put in, divided by the 300 months, equals $400 a month. Of that is a return of capital. So we take the total $700 a month that she's going to receive, subtract the $400, which is actually just a return of capital, and that gives you $300 a month that is actually income. So you multiply that by the 12 months that we're in 2024, giving you $3,600 of the annuity income that was received that is actually income that will be included in her gross income to be taxed. Okay, let's go ahead and go to the next question. Okay, here is question 5. Which of the following features distinguishes annuities from other retirement saving vehicles such as IRAs or 401k plans? Okay, we've learned a little bit about annuities, and if you've watched the previous 2 videos about traditional IRAs and 401ks and Roth IRAs, then you might know some of the differences there. But if not, that's okay. We're going to dive straight into the answer to figure out what are some of the differences here. Okay, here's the answer, and let's just go straight into the explanation so that we can kind of read through it. C, annuities guarantee a fixed or variable income stream for a specific period or for a life, which can include survivor benefits. This is true. This feature is unique to annuities. While IRAs and 401ks focus on accumulated savings, annuities convert these savings into a predictable income stream, which can be guaranteed for the lifetime of the annuitant, providing a unique form of income security in retirement. So this is different than IRAs and 401ks because it is a steady stream. You're pretty much guaranteed to be getting the same amount every month. Now let's look at the other answers. A, which says annuities can offer tax-deferred growth on investments. That's actually also true for IRAs and 401k plans, so it's not that unique of a feature for annuities. B says that annuities can only be funded with pre-tax dollars. This is generally not true for non-qualified annuities, which are typically funded with post-tax dollars. Although qualified annuities can be funded with pre-tax dollars within certain retirement accounts, you're probably dealing with non-qualified a lot of the time. And then for D, which says all annuities allow for employer matching contributions. If you remember right, we talked about employer-sponsored and individual. So obviously this feature is specific to employer-sponsored retirement plans like 401ks and does not apply to annuities purchased individually. So not all annuities can have employer matching contributions. All right, so we learned a lot about annuities. Before we go any further, let's go ahead and do one more part of the process called pillar topics. Now, the idea behind pillar topics, before we get into it, is as you're going through the questions to learn the material, you will notice the things, the concepts, the calculations that keep popping up that are obviously important according to your review course because you've seen them through 4 or 5 questions, so you know they're important, and so you take some time to write them down so that you know them for later. So let's go ahead and look at the pillar topics for this video. Okay, here are the pillar topics. Annuities allow for a portion of each payment to be received tax-free, as it is considered a return of the principal investment. The exclusion ratio is calculated by dividing the initial investment by the total expected return from the annuity. For non-qualified annuities, the portion of each payment that exceeds the calculated return of principal is taxable as ordinary income. This contrasts with withdrawals from traditional IRAs and 401ks, where typically the entire withdrawal is taxed. Annuities provide a guaranteed income stream for a specified period or for life, which can include survivor benefits. This feature distinguishes annuities from IRAs and 401ks, which focus on accumulated savings without a guaranteed payout phase. And finally, annuities often come with higher annual fees and expenses compared to other retirement savings vehicles like IRAs and 401ks. We didn't really go over this in the video, but I wanted to throw it in there so that you know this is a disadvantage of an annuity compared to other retirement vehicles. This can include administrative fees, mortality and expense risk charges, and surrender charges. So again, as you're watching this small group of videos about retirement accounts, remember that annuities can have higher fees, which is a disadvantage. All right, that's it for the 5 questions for this video. Make sure to go check out our free 1-hour webinar training on superfastcpa.com. Again, it's only 1 hour, and we will teach you the key ingredients to passing the CPA exam. Also, if you liked going through these 5 questions, just remember that Superfast CPA members will have access to the full 10-question video when we post it on the members forum. So you can get more of this and more practice by becoming a Superfast CPA member. Be on the lookout for the next video about retirement accounts. Make sure to watch these videos all together so you can kind of be comparing the disadvantages and advantages of each retirement account. If you liked this video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.